Hi, I'm Leah Wheatholter, owner of Workman Forensics, and this is the Investigation Game podcast. For today's episode, I invited Shawna Robinson to join me for a conversation about using tax returns to find assets and understated income. Shawna is a partner at Woodrum Tate & Associates in Tulsa, Oklahoma. She's a CPA with a degree in accounting and also an MBA from Oklahoma State University. She specializes in estates and trust, oil and gas, partnership taxation, and research. And on top of all of those credentials and experiences, she is truly a professional, an effective problem solver, and an overall great friend. And I think I should know, because we used to be office neighbors. Here's my interview with Shawna Robinson. So today, hopefully our listeners will just be real excited about this topic.
I think it's exciting.
Right. I hope you would. We're going to talk about finding assets and hidden income in a tax return. So we've kind of touched on it in a previous episode 4. And Megan and I talked about just some different ways that people hide income in general, and that tax returns are a good resource whenever you're trying to find out what's real or not real. And so I wanted to, hopefully at the risk of not boring listeners, I mean, I don't think we're boring, obviously, but I'd like to just talk about some of the specifics in tax returns so that if a listener wants to go look at their own returns and maybe just understand how it works a little better, just for life in general, but also if they're going through divorce or a partnership dispute, just some things to kind of look for. So I've asked you, the expert, to explain these things to us so that we can know them better. So what if we just start with, I kind of thought we could just break this down to the different forms.
Okay.
And so probably people are most familiar with a 1040,
Right.
their personal return. And so what are some of the places that you would start looking for an asset? What does somebody own?
Well, so the Form 1040 used to be 2 pages long, pre-2017, but then there was a big tax reform. So now the 1040 is actually 1 page with just additional schedules. So that first page of the 1040 basically just summarizes all the forms and schedules behind it. So Schedule A is probably the first place that you would want to look. On the Schedule A, it's your itemized deductions, and real estate taxes are listed there, and also mortgage interests. And while they're not itemized with addresses of properties, a quick search from the county assessor, you can see the property tax that someone would pay in that county, and then kind of reconcile the two. And if there's a lot more real estate taxes on that line of Schedule A, then you know there's other properties somewhere. So that kind of points you in the right direction. Kind of same with mortgage interest.
So I have a question about the real estate taxes. If are we only supposed to deduct the home that we live in?
The home that you live in and your second home or vacation home.
You can have a second
also.
home. Okay.
Yes. And then sometimes there'll be some investment property, which sometimes we see that here as just some raw land that's owned. And there's a separate line there that says investment property.
Okay.
So it would be a non-producing additional property.
Okay.
A non-income producing.
But if you're going to put a business or rental real estate tax on there, that's not
That's not where you
that.
would look to find that. No,
Right.
That actually would be on an additional schedule, the Schedule E. So the Schedule E lists all of your rental properties, and it generally would have the address. Sometimes it will only have the town and city and state, but generally it would have the properties, so you can go find that. It would also have any oil and gas royalties that someone owns are listed there.
Those are valuable.
Could be. Yes.
Could be.
Schedule C is any entities that the person owns and they're the 100% owner, someone that they don't have any partners in that. It's not an S corp. That would be listed. If there's an EIN number, because it's owned by one person, sometimes those are identified by the IRS based on your social security number. But if there is an EIN number associated with it, it's also listed on the Schedule C, as well as the address of the principal headquarters of that company.
Okay.
Then going back to the Schedule E, there's actually 2 pages to it. The first one has your rentals and your oil and gas royalties on it. The second page would list any partnerships or S corps that you have. It'll have the amount of income, and it also has the EIN number for those. You can then take that information and go to your Secretary of State website and find out who the register agent for those companies are.
Right. Okay.
And then Schedule B lists any interest and dividends income that you have. So that'll point you in the direction of any brokerage accounts, any interest-bearing bank accounts, or if there's any interest coming from any partnerships or S corps, those will be listed there.
Okay.
And Schedule D and Form 4797, that points us at anything that's sold. Any stocks that are sold will be on Schedule D, capital assets, or then 4797, any properties that they have sold. So if you're in a divorce litigation, it might be important to know that they've sold some of those assets.
Right. And especially when they sold them, especially if the divorce has been going on for a long time.
Yes.
Did they know about it? That type of thing. And that makes sense. So from a 1040, just kind of on our side of the world and how we use it, is we take all of these schedules that you've talked about and all of the key items that you've talked about, and we just make a list. Just list them out. We don't necessarily have to know what they are or anything to begin with, but just create a list. Right. So one question I do have, because of the changes in the tax forms, and the standard deduction went up, right?
Yes.
So that's going to mean like fewer people are filing itemized deductions, right?
Yes.
So one of our best resources is going to be a little more limited.
Right.
For certain income levels.
Yes, for certain income levels, you won't have the real estate taxes and the mortgage interest for those principal residents. So that's going to cause a little bit of an issue for that.
Yeah, which I'm sure, well, I know that there are other ways we can get that information, but it's just really nice to be able to make that list that I was talking about, to be able to find those things. So, okay. So on related to the 1040, like what are some ways that people could reduce the income that shows up on this 1040?
So one of the easiest ways is if you happen to have a Schedule C, it lists the income for that company and all the expenses. And one big thing is always depreciation. Tax depreciation allows you to accelerate the method. So if you bought $100,000 piece of equipment, there are tax provisions in place so that you can take all the total cost of that asset in the year that you purchase it. So that can drastically reduce your income.
Sure.
That's the biggest way that we see people.
On Schedule C. I guess you could also see it on Schedule E with the rentals.
Yeah. So if you're looking at those schedules, it's important to find the depreciation, amortization, and if it's an oil and gas royalty or working interest depletion, and add those back to the bottom line, because those are non-cash expenses that are allowed on a tax return.
Yeah. Okay. Well, I think I could tell a little story here.
Okay.
One of the ones we talked about. So I'm referencing a book. It's called How They Stash the Cash. Isn't that catchy? A Guide to Finding Income Hidden by a Spouse During Divorce by Mark Cohn. And we picked this up, and I think it was published in 2012. But he has just some interesting stories about, he just has some interesting stories, and they're only a few pages long, but one of the ones is about a financial planner. And he created 3 different types of companies, and the just reducing income on a personal return is what made me think of this one. But he set up a corporate return, he set up a partnership return, and then he set up a personal tax return. And you and I were talking before the podcast. He says in his book that the IRS has auditors that audit corporate, partnership, and personal, and that they didn't really overlap. But you said that that's kind of different now.
Yeah, I think that's still their policy, but they are understaffed at this point. So we have seen auditors that kind of do individuals and also partnerships if the need arises. So it's mostly an understaffing issue, I believe, but they do.
Not like a connecting the dots investigation.
Right, no.
Yeah. So there is that risk there. So for spouses to be aware of. Right. But basically he set up the corporate return where he would put all of his earnings from his financial planning business. And then he set up the partnership as a management company. And we're going to kind of talk about some strategic structures later, but this is just one way to reduce the income on your return for sure. But so he sets up a corporate return for the business receipts. Then he sets up the partnership as a consulting company. And then, of course, he's got his personal return. And so let's say he puts $350,000 into his company, and then he would pay a consulting, quote unquote, consulting fee to the partnership. And with extra expenses, he would make it where the corporate return and the partnership return showed zero net income. And then on the partnership return, as one of those expenses, making it his net income zero, he would then show that there were rental fees and rental expenses paid to the personal return. Well, then by the time it gets to the personal return, the incentive was, let's make this zero. So he had itemized deductions and rental, quote unquote, rental expenses that would show up on Schedule E that you were just talking about, so that it makes it zero income on his personal return as well. And he said that the guy would actually work it backwards. He'd look at how many itemized deductions did he have, because the auditor, I guess, is going to check that back to the source documents.
Right.
That seems to make sense.
Yes.
So he would make sure that matched all the source documents, and then he would back into what he needed to make all the other returns zero.
Yes. And, that's a pretty common practice to do it like that, because you always want to minimize the income for tax purposes at the corporate level. So that's something that we would typically see in a tax planning strategy. But in the event of a divorce litigation, you're just going to want to work that backwards so that you can get to the true income.
Yeah. And I think what also made this just went above and beyond the typical tax planning, and something I didn't mention, is that on these different companies, he would also just put through personal expenses to make, like, he was forcing that net income, not just reducing it by working these strategies, but he was actually forcing it to all be zero. Yeah. So that's a problem.
Personal expenses in a business are definitely not a tax planning strategy, a tax evasion strategy.
Right. We are definitely not endorsing that on this podcast. I mentioned this last week on the check kiting podcast, or last episode, I guess, and that sometimes these schemes seem like more work than just going to work every day. Like, can you imagine trying to back into all that and putting personal expenses through? And then if I was this guy, I would make sure that these personal expenses were like in that gray area. So like having to dig through all of that, I don't know. But if you're never caught, I guess.
If you're never caught, you get more confident in it, and it just balloons from there.
Keep it going.
Yes.
Yeah. All right. Well, so another thing that I've had pop up that I wanted to ask you about is, can you kind of talk about how can a person own or operate a multi-million-dollar company and then only have a salary that shows up on their personal return of, like, I had one the other day of like $65,000, but it's a $40 million company.
Yeah, so that generally would happen if someone was the owner of an S corporation.
Mm-hmm.
So the rule with S corporations is all owners must take salaries, and that salary must be, quote unquote, reasonable. So the IRS doesn't actually ever define what reasonable is, other than a generally reasonable salary for that interest, for that area of expertise in the same general size of company. So that makes it very gray, and it's not something that they check a lot. And as long as the salary isn't extremely low where they're missing out on Social Security or Medicare tax, that's not something that they would it's not a red flag that they would come and check. So you could have a multi-million-dollar company with a one owner, and it's set up as an S corporation, and that owner, if they were doing that job for another company and they weren't the owner, the salary would be $70,000. So that's kind of how they can make that happen.
I gotcha.
Yeah. And it's actually appropriate in the IRS's eyes.
Right. I think that's sometimes shocking.
Yes.
If like our clients never looked at a tax return before, and they're saying, but we own all this stuff. We own tons of land, and we take trips. How in the world are we surviving off of $65,000? And so there are ways to get to that number to actually see what they're living off of.
Yes.
To do a lifestyle analysis, but the IRS, I'm guessing, isn't really doing a lifestyle analysis whenever they go check these things either.
Not generally, not unless they suspect some sort of fraud. Once the audit starts, then they would do something like that. But it's not something that they would do just in a straightforward audit.
And I think it would be difficult too, like some of the cases I'm thinking about that I actually worked with Clayton, who's a partner at Shawna's firm too, but it would be very difficult to go find a comparable salary.
Right.
Like very difficult because maybe they're in such a niche market, or because of the collection of companies that they have, it would be very difficult.
Yeah, and that's what we find a lot when we're helping clients try to determine what a reasonable salary is. Because the salary that they pull, they have to pay FICA and Medicare tax on it, where the income that flows through to them from the S Corp, they don't. So it's kind of a balancing act. But that's a problem that we run into when we're setting the reasonable compensation, is that it is such a niche area that there isn't really much data to determine that salary.
Right. It's not like you can just go out and look to see what, Walmart's paying a person that's similar, or corporations. So, okay. So I have been in training all week, a virtual conference with the Association of Certified Fraud Examiners, and several of the sessions that were available to us were about Bitcoin and cryptocurrency. And so I just thought I would ask, and because I think it's going to start showing up a little more. But if someone has earnings from Bitcoin, where would these show up? Or if they owned Bitcoin, where are they supposed to show up?
So if you just own it, like you just went out and bought some and nothing else has happened, it's not actually going to be on your tax return at the end that year. If you sell Bitcoin, then it would show up on your Schedule D, just like any stock sale would. And the other thing that we haven't seen much of it, but I think we'll see more in the future, is if you do a job and you get paid by Bitcoin, that gets reported to you as if it were cash, so just through your W-2 or 1099, whatever the case would be. But the year that you actually purchase it, we wouldn't see anything until there was earnings off of it.
Okay. Yeah. Until you've sold it.
Sold it, yes.
Yeah. Okay. Anything else on 1040s that you think might be helpful?
I think that pretty much covers it. Just looking through all those forms and trying to track back every piece of property that might be listed. The only other thing is if there's a Schedule C on the company on the 1040, sometimes there's also a depreciation schedule associated with that.
Yeah.
And so instead of just taking that lump sum depreciation number, you would add it back to the bottom line, but also go to that depreciation schedule and look at the line by line items, because that is just a listing of the dates purchased and every piece of every piece of equipment that company owns. And sometimes you can find things like, other personal vehicles. They're not supposed to be there, but they may be.
They are.
So that's a good place to look also.
Yeah, that's a good point. And if someone, I think we've talked about this before, how do you get a depreciation schedule? Because they don't always come back with your return.
Right. So that's just kind of a common practice. Most CPA firms don't provide the depreciation schedule to their clients with a copy of their tax return, just because that way, if there's ever an issue or you're trying to go to another CPA firm, you have to kind of call and ask for that. Just kind of a common practice. But if you request it from the CPA and you signed that tax return, they have to give you one.
Okay, that's good to know. Do you suspect your spouse is hiding assets or lying about his or her income? We've spent the last 8 years working to perfect a system that finds hidden assets and verifies income specifically for divorce cases. And for the first time, we're making this available to the public. Join us for our Find Money in Divorce workshops beginning in August. For more information, visit findmoneyindivorce.com. So let's shift from personal to company for a little bit. And if you kind of want to talk about the different forms and what their purposes are, and then we can dive into what we can find there.
So the Form 1065 is what you would report if you have a partnership. It's just a general form that has a K-1 attached for each partner. The thing with partnership returns is you pay your portion of the tax, and you actually pay what we call self-employment tax on that. So you pay FICA and Medicare as well as income tax on that.
Right.
And that's reported on 1065. The other setup is S corporations, and those have not partners but members, but kind of the same thing. You do not pay Social Security and FICA on the income of an S corp at your personal level, but you do get a W-2 from that. Where in a partnership, you don't get a W-2, you just pay tax on all the income that flows through to you.
And that kind of connects to that reasonable salary that we talked about.
Yes. And that's the balancing act you play with an S Corp, is a reasonable salary enough that the Social Security and Medicare tax is paid in, but not more than you need to, because you want that flow through to come through to you without paying that.
Right.
And then the other type of entity, the 1120, that's a corporation. So it has maybe shareholders, but not actual owners. So the tax is calculated and paid on the form 1120. It's
By
not
the corporation.
By the corporation. It does not flow through to an individual 1040 at all.
Okay.
Other than possible dividends, but that's not really income related. So.
Right.
Yeah.
So within each of these returns, what are some key schedules to look at? Just like we made our list on the 1040, what kind of forms or schedules would we look at, or even statements that we would look at on these?
So with the 1065 or the 1120S, the form 8825 is kind of equivalent to the Schedule E on the personal return.
Okay.
It lists any rentals that they have, the address of those rentals, and the income and any expenses, including depreciation. On all three of them, you would look at the depreciation schedule also. For the same reasons you would look at it on an individual return. Look at what those assets are, see if there's any personal assets that are hidden there. And then also the Schedule D, and that shows any capital assets that have been sold that year, but also any investment properties that maybe you thought that you owned, but really the company owned them and they were sold quickly. So then you can track those.
Okay.
And that's on all three.
All three
of those. Mm-hmm.
Okay. And then what about statements to a return? A lot of times, like, you'll go to a schedule and it'll say C statement, whatever. I feel like those are really helpful sometimes.
Yes. So there are lines on all of the tax forms that just kind of combine a whole bunch of expenses, and it'll say C statement 3. You can go to statement 3 and get a detail of what all of those expenses are, and that can be very telling. And those statements should always be included with the tax return, because the IRS wants to see those too when the tax return's mailed in.
Sure, and they're just at the back.
Yes, they're just in the back of the return.
Flip to the end and
yes,
you'll find them. Okay. So we've kind of talked about the setting up, just with my story, setting up different structures to help minimize income or reduce income, a strategy to reduce income for tax purposes. What are some of these methods? I mean, we kind of hit on a little bit, but you can recap.
One thing that people sometimes do in tax planning is, if you have tiered companies, kind of tweaking the year end on some of those companies, because some industries have areas or times during the year where they produce a lot more income, and you want to kind of stagger those. So changing the fiscal year is one thing that people sometimes do. And then also setting up a management company. Of course, the expenses you put against it need to be legitimate company expenses.
Don't plug personal expenses.
Don't plug personal expenses in there. But that's one thing that you can do to kind of tier that income a little bit. We see that a lot. And then also, the other thing is being strategic with the purchase of your fixed assets, because the tax depreciation provisions right now are so owner friendly. So that's one thing that you want to definitely look into.
Right.
It's
So then by looking at what does this actually look like if I put all these returns or all these financial statements on the same year end, that helps if that strategy's been used.
Right.
Or the depreciation schedule again, like you talked about earlier.
Yeah.
And then realizing how big that depreciation, tax depreciation can be.
Yeah, it can be very beneficial.
Yeah, on the tax side. But if you're going through divorce,
on the tax side, yes.
if you're going through divorce, then maybe not.
Yeah.
Let's see. What are some other items that might cause a difference between book and tax income, other than depreciation?
So if you're looking at a Form 1065 or 1120S, you're going to want to go to that Schedule M1, and that will actually list all the book to tax reconciliation for that return that year. So you're always going to want to look there, because that will tell you every single thing that was reconciled and all the differences. But some of those are federal tax paid.
Mm-hmm.
So that is a deduction on your book income, but it's not a deduction for tax income.
Okay.
So that's one of them. Also, meals and entertainment. Those might be, you're going to fully deduct those on your books because it reflects your cash. But some of those may be not deductible for federal tax purposes or only partially deductible for federal tax purposes.
All right. So do you have any other examples? I mean, we've just covered tax versus book depreciation, but what about some other items that would cause a difference between tax income and book income?
Well, there are several things that are reported differently on book than tax. And the easiest way if you're looking at a tax return is to go to Schedule M1, and that's usually on page 5, right below the balance sheet area of the tax return. And that area actually reconciles book income to tax income. So it will tell you every difference in detail.
Mm-hmm.
But some of the things that would be listed on there would be the federal tax paid, because you'll deduct that on your book income, and it's not a tax deduction, obviously. And then also meals and entertainment. You would take 100% of those off of your book income. They may be only 50% deductible or not deductible at all for a federal tax return. And then any assets that were sold during that year, if there's a book tax depreciation difference, there's going to be a book tax gain or loss difference.
Okay.
So you'll see those there also. And then if you're looking at an S corporation return, if there's any member that owns more than 2% and there was a life insurance policy that the company paid for them, that's going to be a book tax reconciliation item too. So those are just kind of the top cited ones. But any return you look at, you can go to that M1 and you'll find every item that's the difference.
So I just realized you probably should explain what is book. What are we even talking about whenever we're saying book? I didn't think about that.
So book income would just be basically the cash in and out of the company. When you look at tax income, there's definitely you're trying to lower your taxable income, and there's tax laws that allow you to accelerate depreciation or tax provisions that kind of help boost the economy that give you additional deductions. But your book income is kind of like income you got and expenses that you had to pay. So that's probably more of a true picture of your cash in and out of the company.
And I'll also connect it to like, I feel like almost every client loves to say this to us, like, they were cooking the books,
right?
Or there has to be 2 sets of books. Like we're essentially talking about the same thing when we say book versus tax. It's whatever you envision the cooking of the books, books part of that.
You don't have to have 2 sets of books. There's a Schedule M1 on the tax return to reconcile it, and there's not that many items that should be the difference, to be just blunt.
Right, you should just be able to use your financial statements. Okay. So this next topic, this is a common misconception, I feel like, of a lot of my clients, and I don't even do taxes. But the differences between net income and distributions and what you pay taxes on versus just that whole thing, just that whole mess.
So that's an issue with partnerships and S-corps. Usually when I'm trying to explain it to a client, I do have a copy of the Schedule K1 that they receive, because that does kind of help walk through it. But basically, you do not pay tax on distributions you receive from a partnership or S-corp. You do pay tax on your ownership percentage of the income they produce. How that gets reconciled out is that when you first buy into a partnership, or we'll just say an entity, when you first buy into an entity, you give them a sum of money to get your ownership. That gives you basis. Then that year, let's say your portion of the income to pay tax on is $10,000, but you got no distribution. So now if you bought it in for $300, now you're at $310 and you've had no distribution, but you've paid tax on all that. So then the next year, like, there's a loss for the company, so there's no income for you to pay tax on, but you take out $70,000 as a distribution. So now your basis goes down by $70,000, and you don't pay tax that year on that $70,000. That's kind of how it works. It's kind of a hard concept to grasp, only because you're getting money and you're not paying tax on it, or you're paying tax on money you never actually got. But as a partner in a partnership or member in an S-corp, you pay tax on your ownership percentage of income every year. and that gives you basis. When you get distribution, it lowers. In the event that you take more distribution than you have basis, that is a capital gain for you. It's the term is distributions in excess of basis, and you pay capital gain tax on that. So, and that happens in the year that you take that particular distribution, which gets your basis back to zero because you're paying tax on it. So there's always that basis scale that's going up and down that you have to watch. So that's kind of the simple. And the other thing that sometimes people will question or get upset about is like, well, how can a company lose money for 3 years and you still have cash? Like they have to be hiding something. Yeah. Well, go back to that. Generally, the biggest one is tax depreciation.
Right.
Like there's things that are non-cash expenses that lower your taxable income. So that's kind of how you can create cash to give a distribution, but not have necessarily income that matches that.
Right. Right. That makes sense. Yeah. And like you said, you're always paying taxes on the income that's earned. You just may not take it out of the company in that year.
Yes.
So it's already had the taxes paid on it. And then maybe the next year you decide, I'm finally going to take out a portion of this income instead of just leaving it in the company to keep, like reinvesting essentially.
Yes.
So you could decide to take it out.
Yeah. So
and that's the actual like cash piece where you actually get to go spend that money.
Yes.
But you've already paid taxes on it because
you paid taxes on it the year it was earned by the company.
Right. Okay. So that should be clear for everyone who listens to this podcast who then comes to see Shawna or myself. Just kidding. We'll walk you through it. Okay. I'm curious if you have any stories for us.
I did have an audit a few years back, and this client had sold some assets. And when they sold those assets, they basically opened up another bank account in another bank and put that check into it. And they didn't tell us about it. They didn't tell, I don't even think the other spouse knew. The auditor came in, and when an audit comes in, they take your bank statements and they look at cash in, cash out. Well, there was one time when that client had written a check from one of his bank accounts to that other bank account. The auditor saw that opened up an avenue for them to look into that account. They got all the bank statements for that, and they were able to look at that bank account, see those sales. Why were these not on the tax return? The taxpayer was very upset that it was found. They didn't think they didn't want the wife to know about it. They didn't want us to know about it.
Yeah.
The common misconception is I can just go open another bank account and hide that. It's very hard to hide money.
Very hard.
It will always be found. So
I'm still leaving the challenge out there that if anybody wants to tell me of a unique way that they've experienced somebody hiding money, I will tell you how I could find it.
Right.
Just send us an email, podcast@workmanforensics.com. Challenge accepted.
Right.
We can find it. And if an auditor wants to, they can find it.
Right.
Yeah.
Yeah. This wasn't even a very sophisticated audit. It was pretty baseline audit, and it was very simple to find. And taxpayer thought it was bulletproof, and it was not.
Yeah. Well, I really do want somebody to take me up on my challenge, so bad. I want some crazy stories, and then I want to talk about them on the podcast. And then whenever they have to do with taxes, I'm going to give you a call, and then you can come over. Okay, perfect. Although what we don't want are tax questions over the podcast at Workman Forensics. Do not send us tax questions. If you have tax questions, you need to just go talk to Shawna at Woodrum Tate. That's what needs to happen. Anyway, Shawna, thanks so much for being on the show today.
Thank you for having me. This was fun.
Thanks for listening to today's episode. To get updates on future podcast events and resources, please subscribe to our podcast, our YouTube channel, and follow us on LinkedIn, Facebook, Twitter, and Instagram.